Enphase is down 52% this year. I remember last year we were looking at this company, people kept talking about it. It was high flying. It was going crazy. It's up 2,600% in the last 5 years. Mo is making a weird face, so I'm gonna ask him why.
Is this no longer disruptive? Is that why we're down?
I don't know what it is. Maybe it isn't disruptive anymore. Guys, in this video, we're gonna go over some high-level metrics of the company. We're gonna go to our community and look at bull and bear cases that they have provided us. We're going to look at analyst estimates. Of course, we're gonna cover the 8 pillars on the stock, and then we're gonna finish it off with our stock analyzer tool, which will help guide us to what price we should pay for Enphase. So whether you're a beginner investor or a more advanced investor or somewhere in between, there's something in this video for everyone. So stick with us through that the entire time. If you're a beginner and some of these things are confusing, you're in the same boat as everybody else. It was confusing to me and all of our other 200,000 subscribers at some point. So just stick along, watch more videos. You'll understand it better as time goes on. Let's check out Enphase. So they're solar panels, right?
Yeah.
Global energy technology company. They deliver smart, easy to use solutions that manage solar generation, storage, and communication on one platform.
My parents have these.
Oh, they do? Mm-hmm. How are they?
Disaster.
Really?
Yeah.
So you're saying something bad about the company? Mm-hmm. What makes it a disaster, Mo?
It doesn't work the way it's supposed to as far as sending energy to certain parts of the house. My dad spent so much time on this, and he's like,
and he thinks it's Enphase's fault. Mm-hmm. Interesting. Now that's his experience with it. I don't know what other people have had, but this is a $16.7 billion company market cap. That means if you bought every share outstanding, you'd spend 16.7. But Mo, look at this. The enterprise value is only 17.3.
It's actually very interesting for a company like this.
This difference, guys, is essentially the net debt. This is very low difference. This is a very good thing. They have very little overall debt if you net out their cash and receivables, et cetera. That's a good thing for a company because a debt can weigh down a company just like a debt would weigh down a person if they had too much personal debt. Mm-hmm. So we love the fact, as comparing to a company like AT&T that has a $100 billion market cap and $380 billion in enterprise value, a huge difference with a ton of debt. This is quite the opposite. So that's awesome. We've got net income in the last year of $570 million. Oh, Mo, look at this.
Yeah, look at the free cash flow.
But free cash flow of $865. A bigger free cash flow than net income. We like that a lot. Another positive for Enphase. So let's take a dump on most comment about Enphase. 5-year average net income of $230, and also 5-year average free cash flow higher than the net income.
Yeah.
That's a good thing. Usually, guys, net income is the manipulated number that has all these rules adjusted to it, and usually the net income number is higher or equal to free cash flow. Here, free cash flow is actually higher. So that's a positive.
This is, as I'm just glancing at all the metrics, everything looks pretty decent here. Look at the profit margin.
Okay.
Look at the gross profit margin.
Profit margin of 44%. Bottom line, 5-year average of 17, 1 year of 20.5. Now, guys, the reason this has attracted a lot of people is being down 50% year to date is wonderful. I love looking at the big falls as a play, especially quick ones. Because remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So what that means is, in the short run, with big fluctuations, to me, it rings off the bell of, is this expected, right? So here, a big drop-off, is it an overreaction? Is it too much selling? Could it leave something for somebody to look at and say, there's opportunity here? That's what I like about big sell-offs. Same point, when you see a stock skyrocket like Tesla or Nvidia this year, it makes me pump the brakes going, wait a second, until Morgan Stanley opens their mouth and upgrades Tesla, even though they didn't have as high a price on it when it was $100 a share. No comment on that one. But let's go back to oh, wow.
Look at the ROIC first.
23.8%. And the last year was 33.4.
Yeah, it's growing.
Guys, this 5-year return on invested capital, this means they get a really high return on the money that's invested in the business. And with a company that does $2.8 billion in revenue, with I foresee to be a long runway potential, that's awesome. That gives an opportunity to grow their business very quickly and grow their profit very quickly. The question is, can they do it? All right.
That'll be the question.
So let's check out the 8 pillars real quick. And remember, guys, if you're part of our community, you can customize the 8 pillars up to 12 different pillars.
Outside of them diluting the heck out of you.
Oh, my Lord.
Dude. 42 7.5 million shares in 2014, 136.5 this year. Wow.
Guys, for those of you who are wondering why Paul is moaning, this is the silent killer of investing. They are diluting shareholders. Let's say, for example, there are 10 shares outstanding in a business that you own part of, and you own 1 share. You own 1 out of 10 shares, or 10%. They increase their shares by 40%. It takes the share count from 10 to 14, but you still only own 1 share. So you now own about 7.5% of the business versus 10%. You've been diluted. A lot of investors would immediately strike out Enphase saying, I'm out just because of this. Because guys, I don't blame them. The stock was flying high like crazy. So, hey, let's go sell a bunch of shares. But it doesn't, to me, it says we're not caring about our investors. With this high return on invested capital, take the debt on. Take debt on. Instead of punishing your investors by diluting them, take on some debt and use that extra cash flow to go pay off those debts. That's what Tom Murphy at Capital Cities did. And he was one of the best capital allocators of all time. You sit there and you issue the debt and use the cash flow from that issuance of your business and the growth of the business to pay off that debt very quickly. Mo, what are you looking at?
Their share repurchase program.
In July 2023, the company's board of directors authorized the repurchase up to $1 billion of company stock. Guys, this is directly from their 10K.
Yeah.
Huh. Is that 10K or the Q?
This
or the
Q. This is the Q.
Okay. So it's their quarterly report.
Yeah. Oh,
I mean, man, look at their
K. 2021. In 2021.
Our board repurchased. Yeah, but that was different. Mo, look at that.
What?
So look at their cash equivalents, and marketable securities up significantly in the last year. And look at their total debt. Not up at all. 1%.
Yeah.
Maybe they have a hard time raising debt. I have no idea. Maybe they just want to stick with no debt. So to me, guys, I look at this immediately and think, I'm probably not going to be interested until I can believe that they're, man, this is a tough one. All right, so let's go to our community and see what the bull and bear cases are. It's up here in our community chat. I'm going to go right down here to Enphase. Where is that? Up right here. Oh, wow. A lot of great comments.
Expansion into commercial solar and energy storage. Enphase is expanding beyond just its residential solar into larger commercial solar projects, pairing microinverters with energy storage systems. These potential growth markets.
Thank you, Mateo style. That's great.
Let's see.
So again, Mateo says his next comment is, why did it just swing down? They initiated a stock buyback plan. Okay. Let's go look at the gross margin. He says gross margin is increasing. That'd be interesting to see how the gross margin is done. Mo, why don't you do some more? And I'll go look at the gross margin stuff.
Dividend value investor said, me, Kevin, likes this stock, so I'm kind of scared to touch it. It has the Kramer Woods effect on me. That's pretty funny. Here's Wicked Willie. Global solar power market is expected to grow 7.2% per year through 2030 and accounts for 30% of electricity generation in the United States by 2030. Europe, the company says year-over-year revenue triple and increased 25% QQQ with South. Okay. California is the main market for Enphase right now. Florida, Arizona, and Texas have been tough markets for Enphase as non-California sell-through rates fell year-over-year. Okay.
All right, guys, look at this. This is Enphase's gross profit margin going back to 2011. And as you can see, some major fluctuations. Guys, I personally believe that...
Comment.
What was that?
Go ahead.
I personally believe that electric prices are going to go up over time as we have more demand for them, for more electric vehicles, as the world tries to convert to this. Solar panels become more valuable there. Does that mean Enphase is going to directly benefit? Probably, but just because there's an expanding market doesn't mean that this is going to do well. Solar is still a very young industry. There's going to be a lot of weeding out of solar companies. So, Mo, what was the interesting comment?
Fet Cartel said, this is too hard. The future here reminds me of the mobile business when they were going after 3G. Ton of investments ahead, and the cash flows might be negatively pressured with declining government incentives. Business will create a ton of jobs and generate a ton of cash, yet there's so much more to build out while the industry still shakes out the players.
All right.
Pretty interesting.
I like Nelfern's comment. Bull case, most efficient energy distribution system when compared to competitors. So he's basically calling it a better mousetrap. But his bear, very competitive market, which he's right about. Door-to-door sales, does a lot of solar, etc. High interest rates decrease demand due to high amount of financing to purchase the solar panels. Yeah, solar panels cost a lot of money. Got to finance it somehow. Increased interest rates makes that harder. Very valid point, Nelfern. That's more of a industry, I would guess. Bear case, but it's still a small enough market where the growth can still outweigh that. Meet Kevin, that's a great one. Let's see here. What else we got? Thorify. Current U.S. policy incentives promote the adoption of solar plus storage, and that policy should continue if the U.S. wants energy independence. That would be the bull case. Bear case. Largely targets the residential market could see a slowdown as rates increase. Good call. And policies such as net metering can be phased out over time, negatively impacting the economics of adopting solar. So net metering would be, I think that's when it's not based on what your actual usage is. It's like the net amount or something like that. It's something like that effect.
Don't you share it with the electric company? You send it back and forth or something?
Yeah, something like that. But here's another comment from Rob. We call him Tesla Rob because he has his Tesla photo in there. But using analyst projections for revenue and EPS over the next 5 years, Enphase would have a return significantly beating the market. To me, this is a stock with a wide variance. 100% agree with him. This is going to be a very, very volatile stock. And guys, most multi-baggers, which he sits there and says, hey, I think this is a multi-bagger, but I would keep this as 1% of my portfolio. I'm not saying what percent to put it, but I agree with them. This is going to be a very, very volatile stock.
Interesting.
I agree.
See the people that own this stock?
Joel Greenblatt, Ray Dalio, Jeremy Grantham. I'm a big fan of Jeremy Grantham. Wow.
Steve Cohen and a few more. Interesting.
So I agree with them. High risk, high reward for investors. Don't believe it's one for EM guys or most people in the community who think themselves as value investors. I disagree with that, Rob. Remember, a value investor isn't about, it's just about buying when the value, when the price is less than the value and the value is determined. I'm not worried about volatility. I'm more worried about, can I buy it for the right price? And can I determine what the business is going to do? Oh, he added a lot here. Yeah, their ROIC is huge.
Yeah, and it's increasing.
Yeah. Very high ROIC. With a very low weighted. Actually, I think Tesla Rob wins the comment. What do you think?
It sounds good to me.
All right, guys. So we're giving Tesla Rob, our community member, a free T-shirt for having great comments, even though he seems to think that my value investing inhibits me
because he likes Tesla, he can have this shirt.
But he doesn't own Tesla.
I know. He sold it all.
We're gonna give him a special limited edition like Disney Paul and Mo.
Oh yeah, we're
gonna give him a special edition Bill Gates shirt.
I love Rob when he goes on his rampage about Bill Gates. He hates Bill Gates. Rob, thanks for the comments. These are great comments, and thanks to everybody who commented here because this is really why we do this whole community stuff. All right, so let's go back to the software. Let's look at analyst estimates to see what Rob was saying. Oh wow, yeah, look at this, Mo.
Yeah, really good growth.
$5.18 per share this year, going to $11.13 according to the analysts. What's the stock currently at?
$122.
So it's about 12 times 2027 earnings right now, assuming they don't dilute anymore. Revenue going from $2.7 billion this year to $6.2 in the future. So what Rob has said, which I think is great, is that it's going to be very volatile. Are you okay buying a volatile stock? That depends on you as a person. If you look at the major companies that had major runs, 10, 20, 30, 40, 50 plus baggers, they had major drawdowns, which means the stock fell a lot along the way, probably several times. Look at Amazon. Amazon hit a peak of $113 a share, which would be split adjusted right now, basically $5.60 per share back in 2001, and it fell 95% from there before it had its big run up. So you've got to be able to endure these things and stick with the business. Because remember, even Apple had multiple times in the last 20 years where it's fallen 30 to 50%. You've got to be ready for that if you want to find the multi-baggers. But most importantly, you got to find companies that have a very long runway. And solar energy is probably a very long runway. What I mean by that is it's an industry with a lot of growth and a company that's small within that industry. $2.8 billion in revenue is not a lot of revenue for this kind of industry, right? And I imagine solar power is going to be a very, very popular thing, even more as time goes. I still remember the first time I was pitched solar power back in 2000. It was terrible. The guy basically told me it was my duty as a landlord to help save the environment regardless of cost. Yeah, and you notice that. And by the way, this is meant to offend every liberal out there.
I do agree with that
he was
statement.
a liberal idiot.
Oh, I agree with
Like
him.
to me, that was just like because I didn't see him when he was buying his own home. Putting solar panels in his house, even though he could easily afford to put solar panels in his house. I remember he then invited me to go see his home he was renovating, and I'm like, where are the solar panels? He's like, well, it doesn't really make sense for me. I'm like, oh, but I have to do it because I'm required to.
Do as I say, not as I do.
Correct. Do as I say, not as I do. And I'm probably going to get blasted by a bunch of, I get it. And Republican right-wingers are just as bad guys. I do understand that. Don't get me wrong. That's why I'm libertarian. All right, so the question becomes, what's the price to pay for this company? So, guys, I wonder if I've even done an Enphase.
I did it back in March.
You did? I've never done it. So I'm going to start with my first one here. All right, I'm going to do a 10-year analysis. Now, guys, look at this revenue growth of the last 10 years, Mo.
Yeah, I know.
Jesus Christ.
Yeah.
Big time growth. But the analysts don't have it growing that much in the future. Look at analysts. They have them. Oh, no, it's still pretty big. Let's see here. Analysts currently have it going over the next 4 years, 22.6% per year, if I did that right. Yeah, to 24 years, correct. All right, so I have to sit there and figure out what's the right revenue growth to put in for this company over the next 10 years. So if they're expecting 22% over the next 4, let's go 10, 20, and 30% revenue growth. 30% revenue growth for 10 years would take it from $2.7 billion to $37 billion in revenue. Is that possible? I don't know. Probably. But is it probable? I don't know. But that's why we're putting it as our highest level here. Let's see how high we can make that thing. Profit margin. This is what I also love. Growing profit margin as time goes on. Growing free cash flow as time goes on. Mo, how is their gross margin 44% and their free cash flow 31%? I don't know.
I don't know.
I'm going to go 15, 22.5. No, 15, 20, and 25%. For free cash flow, I'm going to go 25, 30, and 35%. Now their PE, Mo, their PE is actually not bad here, 29, and the price of free cash flow is 19. So guys, remember, with a PE, what matters is you start at 15, which is the market average. Go higher with a high ROIC, a high growth rate, which this company has both. And go lower for the opposite. So I think this company deserves a higher multiple along the way. But the question is, at the end of 10 years, will it still have a high growth rate and high ROIC? My guess is the ROIC will still be high, but will the growth rate be high? My biggest issue on this company is the dilution of the shares. Actually, right now, that's the only issue I have with the company, is their dilution. To me, that says they're not thinking of the investor first. PE. I'm going to go with 15, 20, and 25. No. Oh, man, this is tough. I'm going to go 15, 18, and 25. So I'm going to do a little bit different. I usually try to split it. I'm actually going to go this way. I'm going to go 15, 18, and 25 for both.
Okay.
What'd you do, Mo?
I did 16, 20, and 24. All my numbers are a little bit different than yours.
Okay, so give me your revenue growth numbers.
So revenue growth, I did 15, 25, and 35.
Okay.
Profit margin, 15, 20, 25.
That's what I did.
Free cash flow margin, 20, 30, 40.
But Mo, their gross margin is 44%. How the hell are they going to get to 40% gross free cash flow?
This whole area has a lot of potential to change
True.
drastically.
I imagine costs will probably drop big time.
And I can like if things change drastically in the industry, things change.
I think Mo's right about that. I mean, I get it. I put 35 in for free cash flow. All right. What P's did you put? You
I
said
did 16, 20, and 24. And honestly, I could go a lot higher on this high side because my numbers are so outlandish.
Okay. Now, what'd you put for your desired return?
So I did 15, 20, and 25%.
Now, guys, for desired return, this is the return you want to make. Obviously, with more risk, you want more margin of safety. The market, you can get 9 or 10%. So if there's more risk, and this is a growing industry, but with a lot of changing happening, you need to have a higher return than the normal 9 or 10%. The question is how much? I don't know. I think most 15, 20, and 25 is about right. Does that mean it should be this high? No, guys, if you're in the industry and you know it inside and out, your margin, your desired return should be lower because you know the industry.
Right.
But in this one, I'm like, listen, I'm trying to find maybe a couple players in this industry that make small investments with high potential returns, and I kill it on one or two of them.
Yeah.
That might be the play here. I don't know. It's whatever you feel comfortable with. So I'm gonna hit the analyze button. Before we go further, a couple things. One, if you're interested in all the activity in this community and how to join the YouTube's largest value investor community, click this video above after the video is done, and it'll give you a quick video on how you can join it. Two, just stay with me 1 or 2 minutes longer. We're gonna explain this. It's gonna be great. Just hang on tight while we explain this because it's really important we teach you how to fish and not just hand you fish. So I'm gonna hit the analyze button here real quick. The stock's currently at 122. All right, I have a low price of 50 to 80, high price of 230 to 320, a low price of 104 to 156. Wow. It's actually better than I thought. All right. Current price, if you paid the current price and the low assumptions occur, you'll make 9.3%. If you pay the current price and the middle assumptions occur, 23.6. The current price and the high assumptions occur, 40% returns. So guys, Mo, what'd you have?
I had 72 to 96 on the low.
Wow.
314 to 500 on the high.
Wow.
160 to 240 in the middle.
So this is something you're gonna have to go do more, but the 40% dilution bothers the crap out of me.
Now, yeah, I looked at the income statement quarterly. They're starting to buy back a couple shares.
Yep.
But we'll see.
All right, maybe it's going the right way. Guys, thanks very much. And by all means, the people in our community, drop some more comments in this community chat, even though the video is done. Tell us what we might have missed. Thank you for your time.